Welcome into an April edition of Cup of Joe. I'm Mike Carrazzo, joined as always by Nick Webb, our Director of Risk Management, Commodities Hedging. Nick, how you doing?
Mike, I'm doing great. How are you?
Doing good. You're not in your familiar background. Where are you at these days?
I am not. I am you can't see it because if I turn my camera around, I'd be a little too backlit. But right now I'm looking at the Wasatch Mountains, which is in Salt Lake City. So I'm in the Ryerson location for Salt Lake City. You can see through the doorway. We've got some of our offices back here behind me.
Okay.
Beautiful day out here. Beautiful day.
Wonderful. Yeah, I think is this the same location that you wore the 10-gallon hat for us last year?
It is. I didn't bring the hat out this time. It gets a little tricky on flights, so it wears on you pretty quickly. So no cowboy hat this time, but still promise we're going to have a great show today.
Yeah, you good weather out there, I assume.
Better than Chicago.
Yeah.
I thought we were through the snow, but yeah, the last few days have just been brutal. It's time to get out.
Yeah, this is brutal. I mean, well, it's been worse, but by next week it's going to be in the 60s. So that's the typical Chicago spring, right?
That's right.
A lot of fits and starts to spring. Yeah, like you said, we're gonna have a good show today. We got a guest that we're gonna bring on a little later in the show, actually celebrating Earth Day. Earth Day is this month, April 22nd. So that'll be a good chance to talk a little bit of climate control. It's Chelsea Hunt. She's our vertical market manager for the climate vertical, and look forward to talking a little bit with her. But as always, I think we're going to dive into what's going on in the macro world and sandwiched in a little bit of metal talk. So you want to get into it?
Excellent. Yeah. And I'll be curious to hear if the eclipse coming here in a few days is going to impact the climate at all. I think everybody's on the edge of their seat for that one.
Oh, the eclipse. I thought you said the eclipse. I'm like,
No, the
what?
eclipse.
Gotcha. Yes. Are you going to be in a spot to go out and observe it by chance?
I'm not, but actually one of my colleagues, I learned that he's actually got basically some significant others who are so into it. They're actually traveling down to Texas from Illinois to go try and witness the full eclipse. So people are really traveling for these things. It sounds like Airbnbs are booked out in the stretch where you get the full eclipse. So it's not my cup of Joe, ding, but
there you go.
But it is somebody's.
Yeah.
But it is somebody's.
Nothing can beat, side note here. This is Cup of Joe talking eclipse, sorry. But Jason, our producer, he showed us, he was actually on a plane last time this happened. And he has a great picture of the eclipse going over the wing of the plane. So if I knew better, I'd ask him to put those up. But I thought that was a cool looking. I mean, if you're going to be anywhere on the eclipse, I think on board a plane is cool. Yeah.
We might have to start to do a submit your photo for each Cup of Joe going forward with our listeners. Yeah.
Yeah. Hold a Cup of Joe with it. All right.
Well, let's go ahead and hop into it. So first things first, as we always do, we have to cover the safe harbor provisions. These are opinions of Nick Webb, Mike Carrazzo, and Chelsea Hunt this month. They're not the opinions of Ryerson. Do your own research. But we've got some really, really cool content, some really interesting things going on within the marketplace over the last 30 days that I think everybody's going to want to be aware of, and some of the hurdles and interesting things that may cause for market conditions. I promise I'm not always going to have a theme for a Cup of Joe, but I did want to change it up and provide one this month, which is we're seeing some manufacturing optimism, but at what cost? And I'll get into what that ultimately means, but it's kind of one of those things where things are actually running so decently well right now that I think we have to question whether or not it makes sense to cut interest rates because conditions both within the services side of the economy and the manufacturing side of the economy are actually holding up pretty darn well, despite the fact that we've had, the fastest rate hiking cycle in the history of the United States. So let's go ahead and dig into it. I'll show you what I'm talking about. So first things first, as we all, I would say often do, maybe always do, we like to look at this Jackson Pollock, which is the manufacturing PMIs. This is from the S&P Global. And you can see on the left-hand side, you've got all the different regions of the world. And what I think is pretty interesting is when you look over on the far right-hand side, which is going to be the most recent data points, you're going to notice a little more green. And it's been a long time since we've been in the state where we've actually seen things transitioning this direction versus coming out of the green into orange, into yellow, and into red. It's not globally, it's not a synchronous type of situation, but certainly in the case of the United States, if we look at emerging markets, we look at China, India continues to be running extremely hot. We just are seeing a situation where some of these manufacturing surveys are looking a little more positive. And the US data, showing 51.9, that's a pretty decent number. And we've now got a situation where we're streaking 3 months. So Q1's actually holding up pretty darn well from a manufacturing standpoint, if we are to believe the S&P Global survey. And the reason why I say that is, if you recall last month, for anybody who was listening in, the Institute of Supply Management, they also provide their own manufacturing survey. And last month, we had a situation where it was this massive divergence where the ISM surveys were showing decreasing growth, and then the S&P Global is showing increasing conditions. Well, we're back in sync, where we now have, it looks like the S&P Global index or survey won out, and the ISM is now in lockstep with it. It's now showing 1 month, although 1 month doesn't make a trend, but 1 month worth of growth on a month-over-month basis. A couple things I would point out as we sit here on this slide and look at some of these line items within the ISM survey. Obviously, the headline number ticking from 47.8 all the way up to 50.3, that's a big jump. Some of the other areas that are going to be experiencing some fairly big jumps, new orders, production numbers are looking quite strong. Now, this is where we see kind of the, but at what cost? As we're seeing these ISM surveys, the S&P Global surveys ticking up, one other thing that we are seeing is prices ticking up. So we are seeing, this inflationary issue become a little bit more prevalent in the headlines and in these surveys. And that's an issue because, as we all know, from prior couple of Joes, the Fed is trying to dampen the impact of these price increases. And unfortunately, they're kind of going the opposite direction.
Is this a case of raw material inflation, right? Going on, prices going up could lead to that.
There's certainly a little bit of that. And we'll get into some of those items, but yeah, I mean, you look at, and I'm not suggesting that all of these things feed into the CPI directly, but you look at some of these items we talked about in prior months where you've got the stock market at all-time highs, you have gold prices right near all-time highs, you have cryptocurrencies back surging to really high levels, cocoa prices are now more expensive than copper, coffee prices are at record highs. Again, these things may not feed directly into the CPI as a something that the Fed is watching directly, but they are certainly going to feed into the way the end consumer is thinking about, how they're feeling about market conditions, how they're feeling about the economy. So they certainly still matter.
Is that the first time we've mentioned cocoa on Cup of Joe as a commodity?
I think this is the first time we've mentioned cocoa. Yeah.
Yeah.
And it sounds like one of the issues that's taking place is Western Africa is just having a lot of production issues.
Mhm.
The climate's just not in the climate. We can talk a little more about climate here in a bit, but yeah, it sounds like the climate issues are causing some production issues. It's causing the price of cocoa to jump by 300 or 400% just in the last few months. So it's a pretty interesting phenomenon.
As a parent, I can feel that with when I'm buying candy.
Yeah,
for the
no
children.
joke.
Yeah,
I feel it on the coffee side, and
yeah, exactly.
yeah. And what's interesting is when we flip over to the ISM services survey, it's actually the first time since September of 2022. So it's been almost 2 years where we've had both the services survey and the manufacturing survey in growth territory. So if we take a step back, on one hand, we would say that's good news. That's a reason to be optimistic about the economy. And it is absolutely a reason to be optimistic about the economy. But as we all know, there are people on the other side of this equation, Jay Powell and the Federal Reserve, who, yeah, they want optimism. Yeah, they want things to be good, but they don't want things to be too good. And that's where this balancing act is becoming a little bit of an issue. What we're looking at here in this chart is going to be one of the big industrial metals. It's one of the primary ones, which is copper. This is a 1-year chart of LME copper prices. And you can see that just in the last couple of days, we are beginning to see prices move back to 12-month, 52-week highs. And if we refresh this chart to even today, it's actually up about $4.25. So it's even higher. This is an industrial metal that goes into a lot of different things. A lot of economists call it the, Dr. Copper because it wears, it has its PhD in economics. It tends to be a barometer for economic conditions because it's just used in so many different processes and, conduit for electrical transmissions and things like that. So it's a pretty broad based commodity, and it is an industrial commodity that I think a lot of our listeners are going to be curious about. But it's rearing its ugly head again. And a lot of that's on the back of not just not just business conditions overall being good, but also China announced some production cuts a few weeks ago that has done a job of tightening up market conditions and expectations around market conditions for the next few months.
So Nick, color wise, ring it through again. What are the three colors?
Yeah, apologies. I should certainly reference those. Those are going to be some of the key moving averages that traders tend to watch as a sign of momentum. So the pink line is going to be your 50-day moving average. It's looking at the prior 50 days of this chart and constructing that. The green line is a 100-day moving average, and the yellow line is going to be 200-day moving average. All of those are, in essence, just kind of saying the momentum to the upside is building. And what that could mean from the trading community is there may be more and more traders getting bullish this particular commodity, which can cause these swings to be a little more strong.
But it's currently at $4.20.
Currently right in the $4.20 range, which, just in the last couple of months, you can see over the course of 2024, we're up 50 cents. So a little over 10% just in the last couple of months. So it's quietly started to perk back up, not back up to record highs that we would have seen a couple of years ago, but it's quickly heading back that direction, it seems.
I'm sorry to keep parking you there. I just want to understand it. Those three numbers are saying within, so are they projecting that it could lower to those rates over the 50 or 200?
I would say that those numbers are certainly going to act as support, but I would say more so if you see them directionally moving up, it's a sign that there's more and more momentum in people moving into this asset class, whether that's people hedging their cost basis or whether that's hedge funds going out and taking a speculative position. Those are, there are traders who follow these moving averages as a way to say, when you go above it, that's a sign to actually continue buying that asset, whatever it may be, stocks, commodities.
Okay.
Yeah.
Great. Thank you.
No, I appreciate you pointing that out. Sometimes I take these things for granted. And similarly, when we look at a different asset class, crude oil, this is one that maybe we don't have direct exposure to, but I would say we all in society have indirect tangential exposure to crude oil and its products, whether it's gasoline, diesel fuel. And the price of crude oil, fortunately or unfortunately, has perked up quite a bit in the last couple of months as well. And what's interesting is when you look at this chart, it really started to turn back higher right around that time period when, and we referenced this on a prior Cup of Joe, right when Jay Powell started to almost sound the alarm bell that we've beaten inflation and that it's time to begin cutting interest rates. It's almost like crude oil and crude oil traders saw that as a way to say, not so fast. And that's really kind of the trading action that we've seen over the last couple of months. And what's unfortunate is, crude oil is used in pretty much every industrial process. And so it is a little bit of a rising tide lifts all boats as we think about inflation and we think about the cost of anything, be it metals, be it, manufacturing generally. And yeah, I mean, certainly geopolitical tensions are not abating at this point. If anything, I would say even today, we're seeing tensions in the Middle East continue to escalate. And it seems like the attacks are getting hotter, not colder. And that's certainly going to feed through into energy prices as well, which again, unfortunately feeds into or could feed into inflation risks. And that's really where we get into the theme of this month's Cup of Joe, which is, yeah, things are optimistic and things are perking up a bit, but at what cost? And the cost is these things may feed into a situation whereby if we start to see inflation, CPI, PPI, the PCE data points moving higher, not lower, that's going to sound the alarm bell at the Federal Reserve to say, not so fast on cutting interest rates. And you can see if we look at 2-year Treasury yields, they're essentially suggesting that that's what's taking place. They're basically saying maybe we do need higher interest rates for a little while longer to really tamp down inflation, to really cool off a little bit more market conditions before we can actually declare victory. What I find interesting is if we look at the right-hand side, this is a table that was refreshed just a couple of days ago, and it shows all the different banks and their economic forecast on where they think Fed rate cuts are going to be over the course of this year. And it's really got me kind of scratching my head because, if we went back to November, December, sure, at that point in time, you could have said maybe we get 3-4 rate cuts. But now that we've got crude oil perking back up, we have, equity markets at all-time highs, gold running hot, copper running hot. it's really got me curious what these economists are looking at to say that now is the time to declare victory and start cutting interest rates. So I think we're going to see a lot of revisions around these. I think we're going to see fewer rate cuts, at least given the data that we know right now. I say given the data that we know right now, because if there's going to be anything that could change the tune, in my opinion, it would be the unemployment picture. And what we're looking at here is a very long-term chart of the unemployment rate going all the way back to 1950. And you can see that we're still at very, very low levels on a historical basis at 3.9%. Very, very slightly, you might see that it's beginning to move a little higher. And I would say that's definitely got the Fed and many economists, it's got their head perked up a little bit, because if that trend is to continue, we've got these vertical lines in this chart that's a signal of recession. If the unemployment rate were to continue higher into the mid fours, I think we start to have some issues. And then at that point, I fully understand the notion that we would need to cut interest rates. But sitting here at 3.9%, the possibility that maybe we even have a flat print, and it's worth noting, we do tomorrow, Friday, we actually will get the next unemployment publication. It's going to be a really interesting one, because if it's 3.9 or lower, meaning 3.9 or 3.8 or 3.7, I think there's no reason to suggest that the Fed has got to be in any kind of rush to begin cutting interest rates. If it goes higher and it's suggesting that there are a lot of job losses taking place, then I think maybe we'll, I'll change my tune on that. But it's going to be a very important and very interesting data point tomorrow morning to determine kind of where we're headed. But taking a step back and focusing on the whole picture, it is very important to note that manufacturing conditions as they sit right now are looking pretty decent. And if anything, they've actually perked up a little bit, not gotten softer in the last 3 months. And that's good news for us and many of our customers. But there is a little bit of an inflationary feed through that could take place that could cause some headaches here in the coming months.
Well, if I recall from the charts you showed from ISM, and I think it was both on the services and the manufacturing, the one index that was slumping was the employment index on both of those, heavily on the manufacturing as well. Do you see that as concerning to growth of manufacturing?
Yeah, I mean, again, it's soft data, so that's going to be a survey data point. Whereas I would say the unemployment data, the payrolls data, those are actual payrolls going out. The surveys could suggest people just aren't feeling very good about the employment picture.
Yeah.
But yeah, I think certainly they at least provide an essence that things are softening a little bit from an employment picture, from a wage growth picture, which could mean that we're in the early stages. And I think this chart kind of tells us, it looks like we're in the early stages of something moving slightly higher. I think the question is it going to move rapidly higher, or are we going to maybe get somewhere around 4.0 to 4.2%, and then maybe level out a little bit? I think that's what everybody's waiting with bated breath about.
We got someone here in the chat. I don't know if you can answer this, but it says on your employment slide, why is the most recent recession 2023 not showing? Did we have 2 consecutive quarters of declining GDP? So is there a missing data point in here, Nick?
No, it's a great question. So I think we did touch on this, because there are many who would say technical recession is 2 consecutive quarters of negative GDP growth. And we did in fact have that. This red shaded area, unfortunately or unfortunately, is synced up with the National Bureau of Economic Research. It's the NBER. They are a committee of economists that sit in a room and literally determine whether or not we officially are in recession or not. And if that sounds political, it may be. In my opinion, yeah, we did, from a GDP standpoint, actually trigger a recession. That data doesn't show up in here because these vertical red lines are more synced up with the NBER definition of a recession. So somebody out there must be an economist or following our data points pretty closely. That gets a little in the weeds. But yeah, that is why. And I hate to say it, but I think those economists in the room might be saying maybe there are politics involved in saying whether or not we are in the R word or not.
Right.
But with that being said, speaking of bated breath, I think everybody's waiting on pins and needles to hear a little bit more about our Earth Day theme and Chelsea Hunt. So let's, Mike, you want to?
Yeah, absolutely. Yeah. So Chelsea's our vertical market manager handling climate. Now, I think that's everything kind of in the renewable energy space, if I'm not mistaken. Chelsea, I'll let you talk about that. But let's talk a little bit about what's hot. What market trends are we seeing? What could federal incentives like Inflation Reduction do for these sectors? And welcome to Cup of Joe.
Hi, thanks for having me. So I'm
First time.
Chelsea Hunt. I'm the vertical market manager for climate accounts for Ryerson. So what that encompasses for Ryerson is solar and wind, so those renewable energy, but also HVAC and water treatment. So all of those are very important to our climate as things are changing and evolving and new technology is coming out. And also as we had one of the hottest summers on record last year, our HVAC systems are very important to us. So starting with the HVAC market, the residential output is not as strong as it was hoping it would be. Still growth, but single digit growth in that sector. And that's largely due to the interest rates not being cut yet. Homeowners are choosing to repair rather than to replace their units just due to the cost of them. And it doesn't sound like maybe the interest rates are going to be cut anytime soon, it seems like. So that seems like it's going to be kind of a trend through the end of the year, potentially.
I can tell you anecdotally as a homeowner, I know you're talking HVAC, but
Yeah.
Solar is something that's come up a lot in some of the circles, and it's a big upfront cost to put onto your house, right? But you get the tax incentives off for it. So I'm with you where, some of the residential, could slow some of that. I know you're talking HVAC, but this thought about solar panels on the house, but it's a pretty big upfront cost to put that on.
And I think that's where some of those in the Inflation Reduction Act could potentially help consumers install some of these new units. I know that there is some with the IRA legislation, heat pump installations for home is going to be potentially a little bit easier with some of the tax credits available. I think up to $2,000 for homeowners that want to install heat pumps. In terms of commercial construction, there's actually a new incentive plan announced yesterday, the Better Buildings Initiative. And so that's a partnership between end users like Whole Foods, Amazon, Target, and heat pump manufacturers to try to install more units, rooftop units on large commercial buildings by 2027. And if it's deployed at scale, it could actually lower the energy costs by about $5 billion for utilities for businesses in the country.
Chelsea, a quick question for you.
Yeah.
Do you have a sense as to what extent these subsidies can have on the cost of any one of these programs, whether it be it corporate or residential? If you own a home and you want to consider putting solar panels on your roof, and let's say that, I'm just making up numbers, but let's say the cost of the total project would be $15,000. Do you know to what extent any kind of subsidy might pay back a project like that?
I think the subsidies, I think the tax incentive for solar is about 10% right now.
Okay.
I think mostly they're hoping that you'll kind of see that on the life of the panel with the lowered utility costs. But yeah, it is a pretty big upfront cost to do some of these installations, especially with the cost to borrow money being as high as it is right now.
Yeah, that's fair. That's fair.
But yeah, and then on that front, the commercial outlook though is a little bit better. And that's being driven a lot by food processing, education, and data centers. That's kind of where a lot of the construction market is right now for commercial construction. A lot of energy usage in that as well. So this is where some of the increase in renewable energy, bringing more capacity online to the country will be very important. I think I read something recently that data center usage might increase 500% in Europe in the next 5 to 10 years. So we definitely will need to be bringing additional capacity for renewable energy online. So I think that's where the solar and wind will definitely be helpful for us. Yeah, and a lot of that is solar.
Yeah, it's interesting. Over the last couple of months, we've actually spent a little bit of time talking about artificial intelligence and large language models and machine learning and all that stuff. And it seems like in the last couple of months, people have started to sort of wake up to the notion that, hey, these things are going to need a lot of data center work, a lot of energy, and a lot of copper and electrification related infrastructure, and I would say that includes HVAC as well. And it just seems like we're not quite ready for prime time on a large scale.
Yeah, there is going to be a lot of energy usage. I think right now globally, data center usage is 1 to 1.5% of the total energy expenditure in the world, but that could increase, 2, 3, 4, even 5-fold, especially with the AI boom that we have going on. It runs so much hotter than any of the other kind of normal computing we have right now, and so that it's definitely going to increase the need for additional energy capacity.
What was the stat you told us earlier? Every time you use ChatGPT, it's like pouring out a bottle of water or something.
Yeah, it's very water intensive. So, and that's because it takes a lot of the water to cool it down. So every time you're using a simple ChatGPT search, it's like pouring out a bottle of water. So the reclamation of that water is going to be very important as well. So you're seeing some of the data centers install reclamation equipment, which some of our customers are definitely doing to be able to reuse that water over and over again to cool those down.
Well, it kind of harkens back to something I think we've talked about quite a bit in prior cup of joes, and I don't mean to toot our own horn or anything, but I do think a lot of times when we get in these computing rages, whether it's cryptocurrencies or AI or large language models, I think sometimes for a short period of time, people forget that you need infrastructure in order for those things to happen, and then something's got to break or something has to happen, and then we realize, oh yeah, we are going to need water to cool the systems. We're going to need electrification. We're going to need metal. We need galvanized steel for the HVAC systems. Kind of brings us back down to earth and realizes why we need these commodities in the first place.
Yeah, absolutely. Yeah. And then for solar, I mean, we're expected to increase capacity by 38% this year for solar energy. For wind, kind of a little bit more flat. I think globally, we're looking at a 12% increase in capacity. In the United States, it's going to be a little bit more flat this year, flat to up. But solar is kind of the big driver for renewable energy installations.
Hey, Chelsea, I don't mean to be that guy, but I'm going to be that guy.
Be that guy.
Because I'm that guy. I've seen a couple instances in the last, let's say, 3 to 6 months of wind farms in Nebraska and or wherever it may be, and places where you have a lot of weather related events, be it a tornado, be it hailstorms, things like that. And for what I understand, some of these solar farms are getting pretty heavily damaged, at least in spots. I'm curious what your thoughts are with regards to, are there going to be ways that solar farms can be protected or insulated from incidents like that in the future? Because I mean, otherwise that seems like it could be a real issue going forward.
Yeah, I think it was a couple of years ago. I think the damage from hail was about $1 billion. So that is definitely an issue in the industry. There's things that consumers, like homeowners, can do right now to mitigate some of their risk, and that's selecting thicker glass on their panels. So once you get over 3.2 millimeters on your glass thickness, that is kind of the threshold for tempered glass versus just to heat treat it. So that's increased strength. Additional framing to support the panels is important. So if you have a bar behind it or a metal sheet, that can kind of help brace the glass for hail impact. And there's also standard testing for the hail is about a 25 millimeter piece of hail, which for those who are not familiar with the millimeters, a golf ball is like 47 millimeters. So half the size of a golf ball. And we've seen up to grapefruit size hail recently, and there's probably only going to increase these like very heavy hail events. That's what's being forecasted at least. So there's some UL specifications that have increased testing. So they test between a 1 to 3 diameter ice ball and at 88 miles per hour. So if you look at the UL certification for those, you can select panels that have been tested a little bit more extensively. And then in terms of new technology, some of the tracking companies, many of them in the last, I would say 6 months or so, have announced software that they could be bolted onto the existing tracking systems that will put them in hail stow mode. So that'll kind of increase the angle, which is a major part of whether or not it gets impacted. So a lot of the hail is perpendicular to the ground, but when you put in hail stow mode, you increase the angle that they're being stowed at. So that way 30 minutes before a major hail event is expected to happen, they'll autonomously go into that mode to protect the panels. And I think when it was in laboratory testing, I think there was a 90% survival rate. So it'll definitely help some of these like major problems that we're having. I know in Texas, we had one recently where a lot of panels were damaged. they can still continue to function, but they do reduce their output once damaged.
But in reality, I mean, if you're getting a hailstorm, most likely you're not generating a whole lot of solar energy at that time
Yeah.
anyway. So yeah, not a huge deal. Not a huge
Yeah.
issue. Sounds like very
Yeah, and
cool.
I think that's to your point earlier about the eclipse. I know that was a concern that it might put some strain on the grid. Luckily, we did have an eclipse in 2017 that kind of gave some people a good idea of what might happen. There will be less solar output. It's kind of like seeing a sunrise and sunset in the middle of the day. So even as far as California, where they're not in the path of totality, you still will have some effect. But luckily, we have other energy sources, whether that's wind or the traditional sources that we have, could kind of offset some of that. We also have significantly more battery storage than we did in 2017. So that'll definitely help alleviate some of the grid concerns that we might have during the eclipse.
So Chelsea, you certainly know a lot about climate and the great information here. I mean, that leads me to, and you kind of alluded, some of the customers you work with, like what are on their minds right now? What are the things you're kind of helping them work through right now? Some of the, I mean, it sounds like, that's why we have like these vertical market managers, right? You're coming in, you're problem solving, you're looking at things. I mean, what you just described, I think would be, a nice value add, but what's on their mind right now? What are you talking through with them?
Yeah, so I think with some of the acts and laws that have come about in the last few years, there's some refrigerant guideline changes that are happening. The increase for the heat pumps to lower our dependence on fossil fuels. So I don't know if you're familiar with what heat pumps are, how they function, but they basically move heat within your home. So they heat and cool. So if it's cold in your house and you want to heat it, it removes heat from the outside to push them in. And then if you're trying to cool it, it removes heat from inside your house and moves it out. So some of these incentives to increase that in homeowners and allow the homeowners to install these are going to increase their popularity. So that's going to require a lot of metal for these. And we're seeing that kind of play out as they increase in popularity and more people learn about them. Heat pumps are a fairly large market in other countries like Europe. I think Norway was one of the ones that has about 60% of their homes have a heat pump. So as they have gotten better for colder climates, we'll probably see more installations here as well.
Well, you said it's something like that is going to increase your metal spend. How are you advising folks to, how are you cost management on, metal spend side of things? Like what are some things you guys are talking about on that front?
Yeah, I think that's where we can bring someone like Nick in to do some risk management and try to help flatten that out a little bit. Typically you're seeing a pretty well forecasted usage model. So you know how many units you're going to be needing, and that's where we can kind of mitigate some of that risk by hedging that or working with Nick to risk manage that.
No, I would imagine these are probably some pretty long-term, large-scale
projects
that are taking place.
Yeah,
right?
so you're looking at agreements in 2 to 3 years typically to try to mitigate some of that risk.
I just got to say thank you for doing my job for me. Thanks for that.
Yeah, no, this is the Nick Webb infomercial over here.
That's right.
Yep.
One of the products that a lot of your customers use are aluminum extrusions, correct?
Yes. Yeah.
Are you hearing, I mean, there's a lot going on right now with the anti-dumping decision now delayed out until May. Are a lot of your customers impacted by that, have concerns on that?
Yeah, I think that's definitely going to be a concern. A lot of the framework that goes into the panels, so the framing around the edge of the panels is aluminum extrusions. And so if several countries are no longer able to import as cheaply as they are, I think that's definitely going to impact some people. So definitely want to be able to have a domestic supply chain or in place to mitigate some of that risk as we get the countervailing duties and anti-dumping duties once they're announced.
Yeah. And Mike, it is worth noting that, I mean, even as we sit here today, prior to those, anti-dumping countervailing duty announcements, we're already seeing conversion prices on extrusions. I would say tighter than most other aluminum products that we look at. If we compare current conversions to pre-COVID type conversions, they're probably up by about 100%. Whereas I'd say like common alloy conversions are up by maybe 50%. So it's already a market that's starting out in a tighter spot. And some of that arguably is because we have some of these growth markets like solar that's tightening up those conditions a bit.
Wow.
And then the countervailing duties have the potential to actually further exacerbate that.
Right. Well, I know we're going to kick it over to the metals portion of it, but Chelsea, stick around for some questions that come in. But before, we move on from your segment, give us anything else maybe we haven't covered, or maybe a big prediction for the rest of the year? I don't know, anything you want to throw into the fray?
Yeah, I think so. I know we didn't talk as much about water treatment portion of the vertical, but that's, I think, going to be a very big potential going forward as well. With the Infrastructure Act in 2021, there was a $50 billion kind of earmarked for water treatment. So that's drinking water, stormwater mitigation. So I think that's going to be a very big impact industry going forward as we start to see some of these projects come online for replacing lead pipes or just doing municipal water treatment plants as well.
Wonderful. Yeah, if you can stick around, we'll come back at the end, answer some questions. And the Cup of Joe audience is doing some fact checking for us. Residential
Yes,
solar
thank
tax
you for
credit,
that.
currently 30%.
Yes. No, I think the 10% came from maybe a utility person I was talking to.
Excellent. We'll take in that dialogue around the extrusion market and translating that into more of a metals update. I'm going to dive into, as we normally do, talking about what we're seeing in the carbon markets, the aluminum markets, and then the stainless and nickel markets. And we actually do have some pretty interesting developments that have taken place. I think aluminum may have tuned into our Cup of Joe last month when I called them boring, because it's beginning to get a little spicy in that space. But before we do, I want to touch first on the end market dynamics. This is looking at like durable goods data on a year-over-year basis. And if we compare this to the prior month, it's again a continuation of further optimism, more end markets moving into positive year-over-year territory. We just have a couple more of these elements, like airplane shipments. I think farm machinery was prior month, it was negative like 5% or so. It's now shifted into positive territory. So we still have a couple on the negative side with mining and energy, and then ship and boat shipments. And I think even household appliances was fairly negative last month as well. But you can see there has been a shift up and to the left, which is meaning that we are seeing a lot more manufacturing end markets showing a bit more optimism. And again, that kind of just fits the theme where that's propping up some other metals markets. And we'll get into some of that here in just a sec. Now, on the carbon side of things, the roller coaster continues, and we are in the middle of what looks to be a new upcycle. I think this one's going to feel a little different than the prior two. About 10 days ago, so last Monday, we got a price hike announcement from Cleveland-Cliffs. They announced that for hot roll products, they were going to take the base pricing for hot roll up to $900 as a minimum, and further to that, none of the other steel mills have actually followed suit with any price hikes, at least not to my knowledge that I've seen. And a lot of times what that means is if the others aren't following suit, it kind of means that there may not be a ton of enthusiasm around, really jacking prices higher the way we had seen in these prior two cycles back in early 2023 and then back in Q4 of this year. And I think some of that makes sense because there are some dynamics that are a little different this time around, namely, when we look at the raw ingredient side of things, when we look at scrap, we look at iron ore, for the most part, they've joined along in the roller coaster over the last couple of years. But as we sit here today, I do think busheling scrap prices for this part of the cycle have bottomed, but we're not yet seeing, massive stockpiling, massive buying of busheling scrap. We are seeing a little bit of optimism, maybe plus 10 to 20 bucks in prime grades of scrap. But 10 to 20 bucks in scrap doesn't really substantiate $100 to $150 price hike in steel, in my opinion. And then you move over to the right-hand side, which is going to be looking at iron ore prices. Maybe iron ore is a little bit more linked to Chinese markets. We produce less steel from iron ore here in the United States, but it still matters. It's still a raw ingredient that goes into steel production for the blast furnaces. And those prices have actually kind of cratered over the last few months. We've gone from about $140, $145 all the way down to this week, we're down below $100. So there's some pretty rapid deflation still happening within the iron ore side of things. So these two things in summation don't really scream to me, jack prices to the moon. I do think that we have seen, at least for the short term, we've probably seen a bottom in carbon prices. I just don't see a whole lot of evidence from the normal indicators we would look at, whether it's, lead times or raw ingredients, that would suggest that we're going to see a big wave or a big barrage of price hike announcements. And I think that's evidenced by the fact that you didn't see any other steel mills follow suit with Cliffs last week. And futures are kind of saying the same thing. This is a little bit of a tricky chart for those who have the visuals. But for those who don't, what we're looking at is the futures market about a month ago was pretty optimistic that we were nearing a bottom. Price hikes were going to take place, and we were going to see, a couple $100 of inflation in the price of all things carbon sheet. And that's evidenced by the blue line. The green line is going to be as of a week ago, where you still saw optimism. The price hikes were fairly fresh. A lot of people said, okay, here it goes. We're starting a new price cycle to the upside. And then we saw that none of the other mills followed suit. We're seeing evidence that some of the raw ingredients markets aren't really taking off to a large degree. Even though we are seeing some other things like copper moving higher, crude oil moving higher, steel really isn't following too big of a trend or isn't really following along in that path. And that's evidenced by the orange line, which is actually showing that if we fast forward to this week, we've seen a fairly substantial sell-off in futures markets, which to me says traders are basically saying, we think prices are going up, but we don't think they're going up by that much. They're kind of saying we think things may get to $900, but if they get to $900 for hot roll, it's not going to be all that long-lived. And then maybe we see some stabilization around those levels. And I don't know, for myself as a market prognosticator, I kind of think that would be a healthy, welcome thing for the market, that we could actually get something a little bit more tight range, somewhere in the realm of $800 to $900. I think that's an area where, steel mills can make some money. I think end users can buy steel comfortably and confidently and still, make good margins on their finished products. It never works out that way. That maybe this is just wishful thinking, but that's what the futures market is saying right now, is that we may actually see a slightly tighter band on steel futures. But again, this is just a snapshot as of this week, this point in time, based on what we know today. Things often change. That's why we do Cup of Joe every single month. That's why we like to stay on top of these things, because more likely than not, this marketplace will also change as market conditions evolve. What's interesting is we're beginning to see a redevelopment of the spread widening between hot roll coil and the value-added products. And this kind of comes back a little bit to sort of what Chelsea was talking about on the HVAC side. I do think that some of the galvanized end markets are really running strong. And if we revert back to the end market activity, HVAC shipments are one of the bigger, growth end markets. They're fourth from the far left, which is suggesting right around 10 or 11% growth rate, which is a pretty healthy growth rate on a year-over-year basis. And what that's doing is that's feeding into a larger premium for those who buy galvanized steel, just to get, but that spread from hot roll to cold roll now is inching closer and closer to about $400. So historically, from about 2010 to 2020, I'd say the average spread between hot roll and cold roll, or hot roll and like the galvanized base price, would have been $150. Those days appear to be behind us, at least in the short term. And you can see, we got all the way up near $650 for a short period of time back in 2022. I don't think we're heading back to those types of levels, but we're certainly seeing a bit of a squeeze on cold roll and galvanized products as it relates to the pricing to hot roll. I think that's just a function of some of the end markets, automotive, HVAC, things like that are keeping those markets tight. It's causing those premiums to blow out fairly substantially. And with that said, I don't have a chart on this, but it is worth noting that some of the base metals moves that we're seeing across copper, and we'll get to aluminum here in a second. It is worth noting that just in the last couple days, we've seen about 6 to 8% price moves to the upside in the price of zinc. So what that's going to do is, in addition to the premium, just to get to the coating base, you're also going to have coating extras that may be going up if this trend continues, if zinc prices continue up the way they are.
The zinc is the primary coating, right, for galvanized.
That's right.
Is that right? Okay.
Yeah, basically it's literally like a molten zinc bath. It's that has the hot roll, cold roll run through it. Yep.
Yeah.
So those things tend to have a little bit of a lag effect. So we may not see, if this trend continues with zinc prices, we may not see that feed through till maybe the summer months, but I would expect if this trend holds, we would see some coating extra increase announcements from the mills.
Is there a typical threshold that usually kicks in those
Yeah, I mean, I would
Yeah.
say it's more of an art than a science, but there is
Okay.
definitely, if it has a substantial move, call it 8 to 10%, I would suspect that you're going to see the mills watching that and eventually passing that through fairly quickly.
Makes sense.
Now, moving on to the aluminum side of things, I should have bit my tongue last month when I called the market boring. We have begun to see aluminum finally, after about 18 months, perk up a little bit. And I know I want to be sympathetic for our customers who are buying a lot of aluminum. This does mean we may see the potential for higher prices. In the very short term, we're absolutely seeing higher prices. When we look at the LME aluminum ingot price, I've drawn in, again, you see the moving averages. So you've got the yellow line, the green line, and the pink line, which again are suggestive of upside momentum in the aluminum market. We're beginning to perk up above those momentum indicators. We're also breaking out of this wedge, which I've drawn in. For those who can't see it, I apologize. But for those who can, this diagonal white line and then the red line, which is basically acting as support and resistance, we've now broken out of that resistance, which for anybody who follows technical patterns or charting patterns, this is just kind of a sign, whether we're looking at moving averages or this breakout of the wedge, all of them kind of support this idea that we're now kind of in a new regime. And maybe we're beginning to see prices lift off from that dollar per pound area that we've been in for really the better part of a year. What's causing that? Well, one thing is manufacturing optimism. Coming back to the original discussion points that we talked about here in Cup of Joe, the manufacturing optimism is keeping markets a little tighter than some had suspected. A little bit of dollar weakness is helping to provide a tailwind to the markets. And then maybe the bigger factor is China, just in the last month, they had production cuts that amounted to about 10% of their production. So there are some measures being taken place within Chinese smelters that is aiding in tightening up these market conditions. So it looks like for now, at least in the short term, we're going to see higher aluminum ingot prices on the London Metal Exchange. And fortunately or unfortunately, we're actually seeing a similar phenomenon in Midwest aluminum premiums, but for different reasons. This one's a bit of an unfortunate one. It's a difficult one to talk about, but in the last week and a half, if you were living under a rock, you wouldn't know about this, but for those who weren't, the Baltimore Bridge collapse is actually having some impacts, somewhat material impacts on the ability to move not just aluminum, but certain products around the country. And some of the numbers that we've seen is it's suggested that about 22% of aluminum imports that were coming into the country were coming in by way of the Baltimore ports. So that bridge being down in the water, the ship being stuck there, that is causing logistical issues to get aluminum into the Midwestern portion of the United States. So you can see it doesn't look like a massive move just because we've seen such drastic moves back during the COVID era. But make no mistake, just in the last 2 weeks, we've seen spot Midwest premiums move from about 16.5, 17 cents up to, as you can see in this chart, about 20, 21 cents. So that's 20 to 25% growth in Midwest premiums just in a couple of weeks. Now, I will be the first to admit that if they get the bridge cleaned up, if they get all of the disaster situation cleared out, it is very possible that things could resume somewhat quickly, perhaps in the next few weeks. But in the short term, this has caused some tightness and causing some inflation to the price of ingot in North America.
That's a big amount, 22% over the last few years, if you think about that. And you cut that off, and that's going to take a while to alleviate, right? So
yeah, agreed. Yeah, I mean, it's fairly niche in terms of the impact that I've seen the bridge have, but the ones that it does have an impact on, it tends to be pretty robust. Things like aluminum, as we mentioned, aluminum imports, exports, coal. There's a very major coal terminal that exists in that location. I know it's Earth Day, but we can talk about coal still. And then hazardous materials is a big one as well. So yeah, the logistical networks of some of those niche products are pretty bottlenecked at the moment. And as we look at the trading community, we've looked at this chart in the past, but this is looking at the commitment of traders report. It's a fancy way of saying, are traders bullish or bearish? And with some of this news, whether it's the Chinese production cuts or the Baltimore logistical situation, traders have moved from a net short position in the last few weeks to a net bullish situation. And that's 18,000 contracts on the long side, which again, may not look like a lot in comparison to what we'd seen in the last few years, but 18,000 contracts represents, so each contract is 25 metric tons. So call it, about 450, 500,000 metric tons is what the trading community is currently long, which that's a big swing from bearish to bullish. And I think that's helping to provide a little bit more upside to prices in aluminum. So, the commodity that we had been thinking wasn't going to do anything for the near term is beginning to do something in a fairly quick way.
Big month.
Now, flipping over to chrome prices, we don't always talk about chrome prices, but it is worth noting that as we think about beginning in May, we are seeing chrome prices begin to perk up. Not exactly related, but similar to cocoa prices. African production issues, somewhat weather related out of that region, is causing a little bit of inflation in chrome prices to perk up. We expect this to not feed through into stainless steel surcharges until May. But the impact on chrome prices for those who track those things is going from $1.44 up to $1.52. So what that means in stainless steel terms is that's going to add anywhere from about 3 to 5 cents to 300 grade stainless steel, all things being equal to the other alloys. So a little bit of inflation also perking up on the stainless steel side of things. Now, when we look at nickel, however, nickel's for the most part gone back into its trend line that it's been in for the better part of, let's call it 12 months. We did see last month, and we noted this, it looked like a little bit of a short squeeze. We saw the price go from about 750 up to right near 850 in a very quick fashion. We've since reversed course on that, and we're back down in the mid sevens. So fundamentally, I don't see a real big reason why nickel prices need to take off. I will caveat that here in a couple slides, but fundamentally, there's still a lot of Indonesian nickel supply coming to market that should provide a ceiling on how far that market, which ultimately equates to stainless steel surcharges, ultimately goes. The caveat will come here in a couple slides, but we'll get to that here in a minute. And when we look at the commitment of traders report, which again is how bullish or bearish are traders, you can see there was a quick jolt higher, which in my opinion was people who were short, basically covering those short positions and coming closer to being neutral. In the last week or so, we've seen more traders get a little more bearish, basically saying that squeeze is over, back to fundamentals. It looks like the market's going to be pretty well supplied in the coming months. So back on the trend line, I would say, for the most part for nickel and thus for stainless. Now, this is a chart that has only a little bit to do with the commodity markets, but I thought it was interesting nonetheless. And that is, at least within North America, I would say there have been some bumps in the road with regards to the proliferation of electric vehicles. And there's a variety of reasons why that may be. It could be cost. It could be that inflation is beginning to bite too much. It could be that people don't like Elon Musk right now. It could be a variety of things. But what this is ultimately looking at is, and we don't always look at stocks, and stocks don't always equate to sales of EVs, but this is the stock performance of a variety of different automakers. And for the most part, I try to focus on the electric vehicle focused automakers. But what you'll notice is up at the very top, so this is 2-year performance normalized to January of 2022. First, up at the very top right, Toyota Motors is having a great time right now. They're performing extremely well. They actually noted just a couple of days ago that their electric vehicle sales are up like 70 or 80% year over year. They're just going gangbusters. I think their hybrid sales were up 40 to 45%. Really strong numbers there. You work your way down on the far right-hand side. Ford is the second best performing stock, which you may not think of Ford when you think about good performing companies over the last 2 years in comparison to something like a Tesla or a Toyota. And they haven't really performed well. They're actually down about 38% over this time period, but they've performed much better than some of the electric vehicle centric companies. You start digging into the other companies, you got Tesla down almost 60% from a share price standpoint. Keep working our way down. You've got Rivian, which they're a smaller producer headquartered in Illinois. They're down about 90% over this 2-year time period. And then it gets pretty ugly pretty fast. You've got Lucid Motors, more of a niche player, down 94%. Canoe down 99%. And then Fisker, who back in 2014, they had already gone bankrupt once. It looks like they're teetering on the edge. And the point of this slide is to say, there are some headwinds at least in North American markets with regards to people's interest or adoption in certain EV brands. I think we're likely going to see some of these niche companies go bankrupt. They run out of cash. They're going to find out it's really hard to manufacture some of these things. But it is worth noting that there are companies like Toyota who are actually performing quite well and actually kind of a bright spot within the automotive sector. And if I'm trying to peel back the onion and say, what's happening, this could be a phenomenon where people are sort of trading down a little bit, where, some EVs, I mean, Fisker makes an electric vehicle that's $120,000. Teslas are anywhere from 40 to 80, maybe a little more than that. Toyota is probably the one that's making the cheaper end of electric vehicles. So if somebody's looking to make a transition and they're feeling that bite from inflation, maybe they're going to opt down to that more economic version, which would fit the mold of a Toyota. So it's an interesting dichotomy across the EV space. And the only reason why I pull this up is because it does have some ramifications to the nickel markets and thus the stainless markets as we think about adoption of lithium ion batteries, because there is nickel in that content.
The way I see that is like the major automakers tend to rise to the top, right? I mean, it's saying that the trend of EVs may not be on pace for what they've predicted, right? But those that are, Tesla's doing well, as you see here, but Ford and Toyota, people may be just gravitating towards brands like that. And admittedly, I'm very unfamiliar with the bottom four in your chart.
And actually, in talking to some other colleagues, they actually weren't as well, which right, wrong, or different. And the good news is you may not have to be familiar with them because they may not exist. They may not exist all that much longer as they find out that manufacturing is pretty darn difficult. But yeah, I think your point's right. The names and makers that we've known and loved for prior decades may be the ones that continue to figure out ways to make it work. They're probably a little better capitalized, and maybe they make a product that's a little more economic for these types of conditions.
Yeah, good stuff. Nick, what's the headline message on stainless right now? What are stainless buyers? What are they facing?
Yeah, I think we continue to face an issue where, in my opinion, you look back to the COVID days, you think about one of the big end demand markets for stainless is appliance sales. And in my opinion, I think there's absolutely a case that a lot of people who are stuck in their homes, they were told to stay inside. They did a lot of remodeling and upgrades to their appliances during that time with stimulus checks, things like that. I don't think you have to go through those repurchase cycles over a 2 to 3 year period. So I think a lot of people who did that in 2021, 2022 are basically just back to the sidelines. And I think this is all in the face of an Indonesia who is quickly trying to become the OPEC of nickel production. So they're ramping up production in a big way. So you have this weird short-term mismatch of end demand markets they're doing fine. They're okay. They're not great. EV sales are doing pretty well, certainly in some regions, definitely in China, Australia, some of the Nordic countries are seeing a lot of EV adoption. And admittedly in North America, we're seeing growth as well. But I think the ramp up on the supply side for nickel, and as it relates to stainless surcharges, is so robust that it's meeting a lukewarm market, and it's just going to be a somewhat oversupplied space. And so yeah, I think it'll be, for overall stainless demand, overall stainless pricing, I think it's going to be somewhat tepid relative to other markets.
Question here for you about aluminum. New Century Aluminum maybe bidding to invest in a new smelter in the U.S. I believe there might be another one too. What could that do? I know you talk a lot about sometimes overseas not profitable, or they're getting to levels, right, where they might cut down. Does domestic investment in smelters help that?
Yeah, I think it certainly helps. It can potentially help bring down Midwest premiums as we have more people making it in Midwest regions of the country. I think the stat is something along, I don't have the exact numbers, but it's something along the lines of, if you went back 40, 50 years, North America had 40 to 50 smelters. I think we now have 4 or 5.
Mhm.
It's an extremely low number and a very big drop off in terms of, people who are still doing it. So I think it's certainly good news. I think this was, I don't want to sound too political, but I think this is and was the point of 232 and protectionism broadly, which is still very much so in place. And as we talked about, just a little bit ago, it sounds like protection is very much so going to remain in place. And again, I don't mean for that to sound political at all, but just this idea that we have countervailing duties, anti-dumping duties, these things are taking place under both regimes, conservatives and Democrats. So I don't even think it's necessarily political at this point. I think these types of investments are really happening on the back of or because of those protectionist measures, because it's an assurance to people to say, all right, now you can go out and spend money, make these investments, and better supply your domestic markets with products. So, I think generally it's a good thing for employment. It's a good thing for the country, and it's a good thing for having security in certain markets.
Yeah, that makes sense. And staying on aluminum real quick, I got one here for you, Chelsea, but I wanted to stay on aluminum. The labor agreement between Canadian National Railway and Canadian Pacific Kansas City ended on December 31st. Maybe we could be looking at a striker lockout as early as May. I think long and short of this comment is what do you think? Is this on the radar for maybe affecting aluminum market as of yet?
I'll just say I don't have a whole lot of color. I'm not an expert in the labor agreements within that space, so I don't want to comment one way or the other. But yeah, if they do go on strike, I would expect that to be inflationary to logistical networks if that is to take place.
Makes sense, yeah. Chelsea, carbon emission reduction and reporting. A lot of companies are really tasked with that, and it's really an initiative for them. Do you see that driving growth in your vertical at all, or are you hearing that from customers?
Yeah, I think that's part of what that Better Buildings initiative was meant to kind of tackle. So you're seeing it a little bit with trying to lessen the fossil fuel burning for heating, for example.
Mhm.
I think that's where some of those initiatives are coming from, is an ESG perspective of trying to be a little lower the carbon footprint of companies.
Makes sense. Okay.
Yeah.
We're run over a little bit here, but Chelsea, it's been great having you on. Thanks for giving us a little bit of knowledge here on the renewable space and kind of what's going on. Any closing thoughts? Things you'd like to leave the Cup of Joe audience with?
No, I can't think of anything other than thanks for having me. And if anybody ever has any questions about renewables or what we're doing in the climate space, I'm happy to try to help them out with that.
Yeah. You want to give out your contact information? I don't want to do it for you if you don't want to.
Yeah. You can find me either on LinkedIn at Chelsea Hunt or chelsea.hunt@ryerson.com.
I didn't want to give away your phone number to the Cup of Joe audience. Email address.
My phone number's in my email address. So,
Thank
pretty
you,
easy to
Chelsea.
find.
Thank you very much. Nick, over to you for any closing thoughts.
Yeah, I've just got the closing thought, I think generally is, I think we're heading back into, it feels like we're heading back into an era of a little bit of increased volatility across, I would say, most industrial metals. We talked a lot about nickel, we talked about stainless maybe being a different phenomenon where it's very well supplied. But what I want to note is the fact that and for those who have visuals, what I've got on the screen right now is the Bloomberg Commodity Industrial Metals Subindex. And again, we've got these pesky moving averages lines. And I know we've talked a lot about these moving average lines, but they matter for this reason. There are traders, there are hedge fund managers, there are asset managers who are trying to figure out where to allocate capital. And as you can see, we are just very recently beginning to see industrial metals move above their moving average lines, the 50-day, the 100-day, 200-day. This is not investment advice by any means, but there are some times where, this is a fairly beaten up asset class, certainly relative to technology. There could be a phenomenon whereby a lot of asset managers look at things like energy, things like industrial metals and say, these things have been pretty beaten up and battered. This might be a place to reallocate, take money out of things that have been doing well for the last couple of years and move it into things that have been a little more beaten up. And the only reason I bring that up, because you're probably wondering, why is Nick talking about hedge funds? And I'm talking about hedge funds because if they do begin to reallocate capital into commodities, even if we're in an environment where you have nickel that's oversupplied, if a lot of money is flooding into industrial metals, baskets, baskets being like ETFs and things like that, there could be a rising tide lifts all boats phenomenon that takes place. So I think we want to keep a very close eye on industrial metals, because I think we're heading back into a regime where, you look at copper, you look at oil, things are perking up fairly quickly, and things are looking a little more inflationary than they have been for the last 12 months. And so for those think about their cost basis, those think about risk management, I think you certainly want to keep Ryerson and your sales team close, because each market's going to be slightly different. And we want to make sure we're talking with all of you and keeping you informed on this. But I think we're heading into an interesting time period in the next 3-6 months.
Great stuff, Nick. And we'll keep an eye on the jobs report coming out tomorrow. And we'll do this again. May 4th is the next episode. I should mention portions of each episode are now available audio only on your favorite podcasting platform. I've been looking forward to saying that. So check us out, subscribe, and see you all next month.
Just hammer that like button.
Love it.
Thanks, gang. See you.
Bye-bye.